Hey everyone, and thanks for jumping back into the real estate verse. Today, we're going to talk about average mortgage rates in the United States and general effects that it might have on the stock market looking back prior in time. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the ITC newsletter. You can find a link to that in the description below. Every month, we pick one person at random to receive a 1-month free subscription. So if you want to get a chance to win that, you can sign up for that in the description below. Now, you're probably wondering, how did we find ourselves in the real estate verse? And the truth is, I don't really know. But sometimes when you are jumping around from the cryptoverse to the macroverse to the equity verse, it's always possible you go into a black hole and you find yourself in the real estate verse. And that's where we find ourselves today. Now, all kidding aside, I do think to have a good understanding of financial markets, we cannot ignore an asset class that is big as real estate. And we know that it can affect financial markets, whether we like it or not. A lot of wealth is tied up in the real estate market. So if prices are going down over there, people are going to be a lot less likely to spend money elsewhere, especially if the price of their home has been coming down a lot. We also know that as interest rates go up, it could easily affect the amount of houses being sold. It affects the amount of demand, and it affects who can afford various houses because monthly payments go up. So I just want to spend a little bit of time talking about average mortgage rates in the United States. We're going to look at 30-year and 15-year, and we're going to overlay the S&P 500. Now, the gray regions on here are recessions. So not every single recession is going to sort of coincide with a major spike in interest rates or interest rates going up, I should say. I mean, there's been plenty of times where interest rates go up where it doesn't necessarily mean anything for the stock market. But what you'll notice is that we did have 2 recessions at these sort of local tops on 30-year fixed rate mortgages. This occurred in the early 1980s, and both of them corresponded to a recession, and then this one over here also corresponded to a recession. One of the things we could do is to actually look at, say, like the weekly change. All right, so what if we were to look at the weekly change of this and try to smooth it out a little bit? This is what it looks like. And you might notice that when the weekly change of 30-year fixed rate mortgages starts to get somewhat erratic, like it did over here in the 80s, like it also did during the financial crisis, it does end up leading to a recession. And one could argue that we're sort of seeing the same thing happen right now. If I were to overlay the S&P 500 on this, you can see what I'm talking about. Look at this recession over here, where the weekly change in 30-year fixed mortgage rates started to go just absolutely crazy. You can see the S&P 500 was in a bear market, okay? You can also look at the financial crisis and say, all right, when the weekly change started to get somewhat erratic over here, we were also in a fairly deep bear market, a deep recession back during the financial crisis in 2008. So it is difficult to look at what's going on right now and to at least not prepare for a similar outcome. Now, I'm not saying that risk assets can't occasionally rally. We know that. We know that we can get counter-trend rallies and they can do well for a while. But you have to consider, in my opinion anyways, that there are some similarities between what's going on today and what's going on, what has historically happened when something like this has occurred. We might also add, say, a moving average to this to perhaps see it a little bit better. Like if we were to look at, say, like the 90-day SMA of this, look at this, right? Like look at the 90-day SMA of this, and you can see that as it goes up like crazy, like it did back in the early 80s, we had recessions. It hasn't done that since then. You'd have to go all the way to today to see it, the 90-day SMA of the 30-year fixed rate mortgage this high. The weekly change of it, I should say, the weekly change of it. So I can't help but look at something like this and remain cautious, not only on risk assets like stocks and equity or stocks and crypto, but also just in general, like, housing. It does seem like housing is coming under a lot of pressure. I mean, you'd have to be living under a rock to not see that, I think. But there are a lot of similarities between what's going on today and what happened back then. Now, I also want to take a brief minute to look at 15-year, okay? So this is what the 15-year looks like. And what's interesting, right, if you look at where we are today, we're back to the levels we were at in 2008, but of course the path we took to get there has been completely different, because in 2008 rates were more or less just going down at the time, right? They're more or less going down. There was a spike over here, right? There was a spike over here in 2008, but they're more or less going down. If we were to take a 90-day SMA of it, I mean, it doesn't look like anything yet. But the reason is because this is only really just started to go up. And if you take a 30-day SMA, you can see just how quickly this is really starting to move up to the upside. So, when I look at charts like this, right? When I look at charts like this, and I see just how quickly mortgage rates are going up, and I remind myself, if you look at prior times when that sort of stuff happened, let's take a look at like a 14, or let's go look at least a 30-day SMA of this. You can't help but look at this and make comparisons to what happened over here in the early 80s. And in the early 80s, we certainly had a bear market in the stock market. So you can see from 1981 to 1982. Now, arguably, this era right now is most closely mimicking that era. There are certainly differences, but there are similarities. We have high inflation, we have soaring interest rates, and then, of course, by association, 30-year fixed rate mortgages are going up as well, and we find ourselves in a bear market in risk assets. And one of the things that we've looked at before, and I just want to take one more look at this just to provide you an update, if you go look at the bear markets, we're going to go again compare this current bear market of the S&P to what happened in the 80s, and I just want to draw your attention to how they compare. So this is the current bear market that we're in right now. And then this is the one from 1980 to, that lasted a couple of years. This is what it looks like. Okay, so if it were to continue to play out, right, if something like this were to continue to play out, maybe we have another rally back up. We put in another like lower high. We come down and put in another lower low. We go back up and put in a new high. And then maybe we put in one more low. If it were to play out in a somewhat similar manner. These are all things that I think are worthwhile to consider as we continue to navigate this stuff. But I do hope that sort of the entry into the real estate verse is somewhat interesting for you, and I think it's at least somewhat useful to look at this sort of stuff and look at, say, like the weekly change of it, and so you know what, we're not going to say that anything is exactly how it was back then, but there certainly are some similarities between the rate at which 30-year fixed rate mortgages are going up and what they did back over here in the early 80s, when we also know that we were fighting high inflation. So again, if you guys like the content, you want to see more stuff on real estate, leave a comment down below. Make sure you subscribe to the channel, give the video a thumbs up, and remember to check out the ITC newsletter. Again, you can find a link to that in the description below. I'll see you guys next time. Bye.